Every day, millions of people spend $5 without thinking twice on coffee, snacks, or subscriptions they barely use. But what if I told you that same $5 could transform into lifelong financial freedom? The real question is, are you sipping away your future wealth without even knowing it? In this video, I'll walk you and Josh step by step through everything you need to know to get started, starting with what dividends are and why they're the ticket to financial freedom, how to set clear goals and timelines that keep you on track, and the key numbers that show whether a company's dividend is safe. I will show you how to select stocks for your portfolio. We will make a real-world stock portfolio, and in the end, I'll show you how just $5 a day in that portfolio can snowball into more than $1.7 million that pays around $8,000 in monthly dividend income. But first, let's set the stage. What are dividends, and why do they matter? Think of it like this. When you own a piece of a company that pays dividends, you're not just holding a stock, you're sharing in the company's profits. Every few months, they hand you a portion of those profits as a thank you for being an investor. That's your dividend. Dividends are valuable because they offer two benefits at once. First, they create a steady income stream that can be used or reinvested. Second, many companies raise their dividend payouts over time, allowing the income received to grow year after year. Combined with reinvesting those dividends into additional shares, your money starts compounding, snowballing into something much bigger over the years. More on that later in detail. Another key advantage is stability. Stock prices jump up and down all the time. That's just how markets work. But dividends tend to stay steady, giving you a sense of stability even when everything else feels unpredictable. With this foundation in place, the next step is to establish clear goals and ensure a strong safety net. Before picking dividend stocks, the first step is to know the purpose behind the investment. Investing without a goal is like driving without a destination. There may be progress, but no clarity on whether the path leads in the right direction. The first thing is setting a clear goal. For some, that might mean creating a stream of $200 per month in dividends within 5 years. For others, it could mean building enough dividend income to cover basic expenses in retirement. The exact number doesn't matter as much as being specific and realistic. If you know what you're aiming for, every dollar you invest suddenly has purpose. The second piece is your timeline. Dividend investing is not a get-rich-quick game. It works best when you give it time, years, even decades, because compounding and reinvesting need room to do their magic. The longer you stick with it, the more meaningful the results become. On the flip side, if you go in expecting big results in just a year or two, you'll probably get frustrated and give up too early. And here's the part most beginners overlook: your safety net. Before you ever buy a single share, you want to have an emergency fund set aside. Because life happens. Unexpected bills, car trouble, medical costs. And if you don't have that cushion, you might be forced to sell your investments during a downturn just to cover expenses. That not only hurts your plan, but it also takes away your peace of mind. With a safety net in place, you can ride out the bumps and stay focused on the long game. Once you've set your goals, timeline, and safety net, the next step is figuring out what to do with the dividends you earn. Because here's the truth, just collecting dividend checks isn't what builds long-term wealth. The real magic comes from how you handle them afterward. One of the most popular methods is something called a dividend reinvestment plan, often shortened to DRIP. With this approach, every dividend payment you get automatically buys you more shares of the same stock. It's completely hands-off. And here's the best part. Those new shares also start paying dividends, which then buy even more shares, and the cycle repeats. Over time, that snowball gets bigger and bigger, and your portfolio starts growing almost on autopilot. Let's put some numbers to it. Say you invest $1,000 in a stock that costs $10 a share, and it has a 4% dividend yield. That gives you 100 shares to start. In the first year, those shares pay you $40 in dividends. If you just pocket the cash, that's where it ends. But if you reinvest, that $40 buys you 4 extra shares, bringing your total up to 104. In year 2, your dividend isn't based on 100 shares anymore, it's based on 104. So now you get about $41.60. That's small, but notice the difference. You didn't add any new money, yet your income grew. Reinvest again, and by the end of year 2, you'll have 108 shares. By year 3, your dividend income climbs to around $43.20, which buys you a little more than 4 new shares, bringing you up to 112 shares total. And it keeps going like that. It's not about the $3 extra, it's about the fact that each year the snowball picks up more snow. Give it enough time, and what starts as a trickle turns into a serious stream of income. Another approach is manual reinvestment, where dividends are collected and then directed into the best opportunities, adding to a strong holding or buying something new. This method provides flexibility and greater control. Some investors, particularly in retirement, choose to take dividends as cash to cover living expenses. While this is perfectly valid, it slows compounding during the growth stage since the money is no longer reinvested. Taxes also influence the outcome. In regular accounts, dividends are treated as taxable income whether reinvested or not. In retirement accounts such as Roth IRAs or 401ks, taxes can often be deferred or even avoided, which makes reinvestment even more effective. But reinvesting only works if the companies paying those dividends can actually sustain them year after year. And that's where step 3 comes in, checking dividend quality before you ever buy a stock. Before you add a stock to your portfolio, you need to ask one simple question. Can this company actually keep paying its dividend year after year? Because the last thing you want is to chase a high yield, only to watch it get cut when times are tough. The first thing to check is cash flow. Dividends aren't paid with accounting tricks, they're paid with real cash. If a company consistently generates more cash than it needs to run its business and invest in growth, then it has plenty left over to pay and even increase its dividend. But if the cash flow is weak, that dividend could be on shaky ground, no matter what the yield looks like on paper. The second check is debt. A company can technically borrow money to cover its dividend, but that's not a sustainable strategy. What you want is a healthy balance sheet where debt levels are reasonable compared to profits. That's a sign the company has real strength behind its dividend instead of propping it up with loans. The third check is durability. Ask yourself, does this company have a business model that can survive tough times, not just good times? A business that only thrives when the economy is booming is far more likely to slash its dividend during downturns. But companies that provide essential products or services, things people rely on no matter what, tend to be the most reliable dividend payers. So those are the 3 filters: strong cash flow, manageable debt, and a durable business model. Together, they help you avoid falling for dividends that look great today but disappear tomorrow. A slightly lower yield from a stable, reliable company is always better than a high yield that vanishes overnight. In a couple of minutes, I will show you how to make a real-world stock portfolio, and in the end, I'll show you how just $5 a day in that portfolio can snowball into more than $1.7 million, paying you around $8,000 in monthly dividend income. But first, how should you structure your portfolio? A simple way to do this is with a core and satellite approach, but here I'll keep it even easier by assuming everything is equally weighted. The core is the foundation. This could be a broad dividend-focused ETF. It provides instant diversification, stability, and reduces the impact if one company struggles. Think of it as your anchor. The satellites are the individual dividend stocks you select. These give you the chance to boost growth and tailor the portfolio to your preferences. To keep things simple, let's assume everything in your portfolio is equally weighted. That means if you hold 5 positions, each one makes up 20% of your investment. No one stock gets to dominate, and you don't have to stress over complicated allocations. It also creates a built-in discipline. If one stock grows much faster than the others, equal weighting naturally pushes you to rebalance, keeping your portfolio from getting lopsided. This structure makes it easier to follow your plan and stick with it through market ups and downs. And once your structure is set, the next logical question is, how do you actually decide which dividend stocks deserve a spot in your portfolio? That's the next step, stock selection criteria. The first criterion is dividend history. A company that has paid and increased its dividend for many years shows reliability. 10 years or more is a strong sign because it means the business has been through good and bad markets and still rewarded shareholders. Next is the payout ratio. This number shows how much of the company's profit is being paid out as dividends. A ratio under 60% is generally considered safe, leaving enough room for reinvestment in the business and future dividend growth. The third is dividend yield. Too low and the income doesn't add up. Too high and it may be a warning sign of risk. A healthy range for beginners is typically between 2% and 5%. The balance offers income today with growth potential tomorrow. Another important factor is earnings and revenue growth. Companies that consistently grow their profits are better positioned to raise dividends. If earnings are flat or declining, the dividend may eventually be cut. Finally, look at the business model and competitive strength. Strong companies often have what's called a moat. something that makes them difficult to compete with. It could be brand strength, unique technology, or a dominant market position. Businesses with durable advantages are more likely to keep paying dividends for decades. By applying these criteria, history, payout ratio, yield, growth, and business strength, you create a reliable filter. It keeps weak companies out and helps you focus on dividend stocks that can actually support your goals. And now that you've got the rules, it's time to bring them to life. Let's take a look at some real-world examples and see how they fit into a dividend portfolio. Up to this point, we've talked about the what and the why. Now let's see how it all works in practice with actual stocks and funds. The first piece of this portfolio is the Schwab US Dividend Equity ETF, ticker symbol SCHD. This one makes a perfect core holding because it's diversified across dozens of reliable dividend-paying companies. Right now, it offers a 3.76 dividend yield, plus it has grown its dividend by 10.43% a year over the last decade. On top of that, the share price itself has averaged 8.23% growth annually. This makes it an excellent core holding, anchoring the portfolio with broad exposure to reliable dividend payers. Now let's select the satellite stocks for our portfolio. For this, I have Morgan Stanley with the ticker symbol MS. It offers a 2.58% yield, but what stands out is its impressive 22.4% 10-year dividend growth rate and 17.01% annual share price appreciation. It combines consistent income with aggressive growth, making it a strong addition to the financial side of the portfolio. I also selected Goldman Sachs Group with the ticker symbol GS. Its 2.05% yield is modest, but the 17.92% dividend growth rate and 15.74% share price appreciation show a company committed to rewarding shareholders while growing in value. From the media space, we add Nexstar Media Group, ticker symbol NXST. This stock is a bit of a hidden gem. It pays a 3.75% yield, but what really stands out is the growth. Its dividend has skyrocketed at 26.01% a year over the past decade. Pair that with an annual stock appreciation of about 15.11%, and you've got both higher income today and incredible growth for the future. Finally, we round things out with L3Harris Technologies, ticker symbol LHX. This one gives us exposure to the defense sector. The yield is lower at 1.62%, but the company has still grown its dividend at 9.56% a year, with the stock itself climbing around 14.76% annually. It's steady, reliable, and adds diversification to our mix. The next step is to calculate your portfolio metrics. Let's start with dividend yield. Because we're using an equal weight portfolio, the portfolio yield is simply the average of each holding's yield. List the 5 yields: SCHD at 3.76%, MS at 2.58%, GS at 2.05%, NXST at 3.75%, and LHX at 1.62%. Add them together first. 3.76 plus 2.58 plus 2.05 plus 3.75 plus 1.62 equals 13.76%. Now divide by the number of holdings, 5, to get the average. 13.76 divided by 5 equals 2.752%. Rounded to 2 decimals, your portfolio dividend yield is 2.75%. You can repeat this exact approach for the other 2 metrics as well. Average the 10-year dividend growth rates to get the portfolio's dividend growth rate, and average the annual price appreciation figures to get the portfolio's price growth. Using our numbers, the portfolio's 10-year dividend growth rate is 17.26%, and the average annual share price appreciation is 14.17%. Once the right stocks are selected, the next step is deciding how to buy them. Having a simple framework helps avoid second-guessing and keeps emotions out of the process. The easiest and most reliable way is to invest a little bit each day instead of trying to time the market. Putting in $5 a day builds your positions gradually, and because prices move up and down, you end up averaging into a fair price over time. This is called dollar cost averaging, and it keeps emotions out of the process. Position sizing is simple when you're investing daily. If your portfolio has 5 stocks, that $5 can be split evenly, $1 into each stock every day. Most brokers now offer fractional shares, which means you don't need to buy a full share at once. Even if a company's stock trades at $300, your $1 still buys a fraction of it, so every dollar is working for you. When buying, focus on consistency rather than chasing short-term moves. If a strong company's stock price dips but the fundamentals are still solid, those dips actually work in your favor. You're getting more shares for the same daily investment. On the other hand, chasing a stock just because it's spiking usually leads to disappointment. With a thoughtful approach to buying in place, the next challenge is knowing when to sell, or at least when to pause and reevaluate. Dividend investing is a long-term game, but there are still red flags you should never ignore. The biggest warning sign is a dividend cut. If a company reduces or suspends its dividend, it's usually because profits and cash flow are under pressure. Another red flag is a payout ratio that climbs too high. If a company is paying out nearly all of its earnings as dividends, it leaves little room for reinvestment or future growth. That kind of dividend is rarely sustainable over the long run. Watch for declining cash flow or rising debt levels that don't match earnings growth. These can be early signals that a dividend is at risk. If a company no longer meets your quality checks, strong cash flow, manageable debt, and durability, it's often better to rotate into a stronger dividend payer rather than hope things improve. Now that you know when to step back, let's zoom out and look at the big picture. What happens when you stay invested, reinvest dividends, and let compounding do its work over time? Let's say Josh invests $5 a day, about $150 to $155 a month, into a dividend portfolio that we have selected, and use a dividend reinvestment strategy. By the end of the first year, Josh would have invested around $1,825. This sets the stage for future growth. By year 10, the portfolio is projected to grow to roughly $42,000, and annual dividend income will be about $1,000. By year 20, the portfolio will be valued at around $272,000, with yearly dividend income projected at $11,000. By year 30, the portfolio will be worth over $1.73 million, and annual dividend income will approach $95,000, about $8,000 a month. The pattern is consistent with how compounding works: minimal impact in the early years, followed by rapid acceleration later on. The turning point comes after staying invested long enough for reinvested dividends to build on themselves. Want to know how to turn a one-time $500 investment into a portfolio that pays over $4,000 in monthly dividend income? Click the video on screen to find out.